Welcome to Let's Go Live. I'm GiGi and I have with me financial wellness author Mick Heyman. Welcome, Mick. It's so glad to have you.
Thank you so much, Gigi, and glad to be here finally. Sorry for being a little late.
No worries. We're going to go through a bit of fast hour, so we're going to get right into it. Are you ready? You're in the hot seat.
I am ready and excited for it.
Me too.
So
What I thought I'd do, because you have such diverse bio and also so much experience, I thought we'd split the interview in half, where the first half is going to be for your author side, and then the second half we can talk about your investment company, because I find that fascinating as well. 40 years is quite the achievement, and congratulations for that.
thanks. It's been a bumpy road along the way, but been glad to survive it.
Yeah, we can chat about the market like in the second half of the market, second half of the hour, because whew, it has been a bumpy ride of late.
That sounds great, and great to start the way you're talking because that will set up our market talk by talking about the book.
Perfect. So, just to start off, what made you write? It's called Mellow Your Money. What made you write it?
Well, I kind of wrote it. I had been writing little articles along the way, and then during the pandemic, I thought maybe I'd put some of these stories together and see if I could help more people with calming down because there's always something to be excited about and worried about, and the fear mongers are out there, every other week. And I just thought people don't have to be so worried all the time. And there's plenty to be worried about in life, but it doesn't have to be about your money all the time as far as building a long-term investment portfolio. And I thought back in my life, what taught me? And it was never a textbook. It was always stories. It was always experiences. And I thought, that might be a unique way of attacking this because I never liked textbooks myself. And so if I could kind of teach through my stories, some of them are about investing and about what I learned in the markets, and some of them were about my life that taught me about investments. And of course, some of my investing stories taught me about my life. And so I thought I'd write it in kind of a hopefully fun and funny way and have it be more readable for people. And so that kind of was what started me on that track. Just thinking about, there's so much information and mostly useless information for people to follow. We don't learn about it in school. And so I just wanted something approachable so that hopefully over time people could relax a little more and think about other aspects of their lives. So,
Okay, so I think that's genius. I want to backtrack a little bit because there's a lot to cover in that opening statement. But first of all, it's kind of philosophy mixed into financial. And you had said people get really uptight about money, but I feel like that is a very commonality globally because this podcast goes global. And so money is what makes the world go round. It's the difference between, if we can put food on the table or not. So I understand not only when you have, when we're having big rallies in the marketplace, people still worry about money. So it's not just like recession or the price of eggs, which is like the dialogue that we're having right now, but how do you talk people down from that? How does that book help people? If you could just kind of break down a little bit about the book.
sure. Some of it is perspective that as you say, there's always something to worry about with money. And so one of the early stories I told about was about an early assignment I had, which was we had a new computer. Back then, you didn't have the internet. Again, I'm dating myself. The only way to get information out was to go back and get it out of old newspapers. And so, it was Mick, go to the library and each week write down what these various things were that we wanted to track in our new computer. And so, of course, I'm starting back in the 1920s, and each week I'm gathering this information, but I couldn't resist. It wasn't like I was a great history lover in college or anything, but I could not resist reading the history from the 20s coming forward to the 80s.
Okay,
And it was
can I pause you?
fascinating.
Can I pause you right there?
Yes.
When you use the word history, it's such a broad stroke. When you're going back and doing this research all the way back to the 20s, which is 100 years back, what piece of research are you talking? Are you talking market? Are you talking pricing, recession, cost of?
So we were trying to build these graphs. So we thought, let's track the Fed funds rate. And
Oh,
of
yeah,
course, if you hit Fed funds rate now in Google, you see a nice little graph and it's
right.
beautiful. You couldn't do that back then. And you had to create with putting the numbers in each week to create that graph. Boy, this sounds old fashioned, doesn't it?
It,
And the same thing goes with like the GDP or all these statistical things. In order to get these graphs, we had to kind of build it. So these were the actual numbers I was looking at, but it's not what fascinated me. What fascinated me were the headlines. Each week I had to open up that paper and something else was there for somebody to worry about. And it woke me up to think, holy cow, they were scared to death in, 1941 after the Pearl Harbor. And
Mhm.
I knew that we were going to survive it because, I'm in the 1980s. But each week something was there to scare people. But having that perspective that we do survive and having that perspective to pass on to clients to say, this is not new. Human nature is to worry. Human nature is to to catastrophize things and make us think we're not going to survive. Who thought, back 5 years ago? Well, no one predicted the pandemic, and here we're all worrying about toilet paper and the market and everything else, and that too is now part of history. And so having that perspective that we will get past things, this too shall pass, that kind of thing that's cemented in my brain was one of the things that I wanted to pass on to people is first of all, have that perspective that we will get past whatever challenge it is. Because for hundreds of years, people doubted whether we would. And each time we do.
Well, I think you have a good point. I do want to backtrack one. Most people do not know what the Fed funds rate is or some of those analytics. I do have a financial background, so I do know. So maybe you can just talk a little bit about what is the Fed funds rate an indicator of to the everyday person, especially in this
Sure.
economy.
Sure, and it's actually fascinating, but because what we found, and I think it's still true, is that people look at all kinds of things to try to predict the market. And of course, one of my strong emphasis is don't try to predict too much. But historically, if you look at what impacted the market the most over time, it's interest rates. And of course, sometimes we read about the Federal Reserve raising rates or lowering rates. And sometimes you'll see the economy is weakening. Think of the pandemic. No one was doing any business. The economy, the economic numbers were terrible. But if I told you the market actually was up 15%, actually 18% in 2020, people would say, how did that happen? Well, the Federal Reserve reduced their interest rates down to zero, which that's borrowing costs for people. And so they were supporting the economy and the market by lowering interest rates. So even in a terrible economy, when interest rates are low, the stock market tends to look forward and say, eventually, low interest rates are going to propel business. Same thing. Sometimes people look at really good economic numbers and they say, this is fantastic. We're going to go up and up and up. And yet the Federal Reserve then starts fighting inflation like they did in 2022. And in the face of a good economy, rates rose from a very low level up to about 5%. The stock market was horrible in 2022. It was down 20%. Was it the economy? No, it was inflation and interest rates. And so that's one of the reasons why we track what the Federal Reserve is doing. And that was one of the things back in the 80s we wanted to track. And you could get this back in the 80s from people, various stock market people showing you, but we really wanted to do it ourselves. Of course, me being a young person wanted to do it by myself. And so that's kind of helped get me to the library to get those numbers.
So when you were doing your trend analysis from 1920 all the way through, was that your purpose for the book, was to go and look at the interest rates or to look at like it, indicators versus the stories? Because I'd imagine you set out on one course to write your book, but then the research tells you a different story.
And so actually, it's kind of interesting, and I even poke fun at some of these numbers in my book because what I became fascinated with, and of course the interest rates are important, but what I became fascinated with was more the philosophy, more the striking tone of the people when they worried about these headlines each week, it went against what the market was doing. And so it was more the stories that attracted me as opposed to the numbers. And that's what drove me to actually writing the book the way I did because I told a story in the book about me not being a numbers guy. When I took statistics in college, what I remember after the midterm was the professor coming up to me and saying, Mick, I know you don't know much about statistics from your midterm grade, but let's figure out what are the odds of you passing this course. The drop off is just a few doors down. That's where I suggest that you go.
That's
And
brutal.
so that was brutal but accurate. I did eventually pass it, but numbers was never my thing. I loved philosophy. I loved learning through stories. And so again, that's the way I wanted to pass on my knowledge of the market is through these experiences.
Well, and your book is about the stress-free approach to investing. So what made you decide to go that route? Because I'd imagine you have this treasure trove of research. You have all these beautiful stories that you can bring into the book, but how do you decide that's going to be a stress-free approach?
And so what I figured out is what is it that relaxed my clients and me through some of these ups and downs that we've experienced over 40 years. And so what was it? Well, one of them was that historical perspective. Another was understanding what relative victories are. And I told a cute little story about a basketball game that I played in, and we were down like 92 to 20, and the coach was furious that the other team wanted to get to 100, so they still had their starters in. And he looked at me and he said, Nick, what should we do? And I said, how about let's try to hold them under 100? And of course, he says, yeah, that's a great idea. Mick, you sit down. He put our starters back in. And of course, the last few minutes of that game were furious. And in the end, the score was 99 to 28. We ran off the court like we had won the Super Bowl. Their fans are throwing stuff at us and they're furious.
Oh my God.
You know, and of course, that wasn't a victory, but it was a relative victory because at that moment we achieved what we could. And so drawing that analogy to the stock market, so many times people are talking about trying to earn this amount or trying to, their neighbors are talking about buying Bitcoin and how much money they made. And it's really about your objective, each person's objective. And that's the relative victory that each person should aim for, not beating their neighbors at trying to, outperform whatever they're doing, taking the kind of risk that other people are taking. Figure out what your risk should be, what your goal should be, and stick to it. And in today's world, I think it takes courage to do that. It's not simple. You say, oh, what my objectives are, and I'll own this amount of stocks. And then something happens, or someone says, oh my God, you should own this, or you should do that. And we get driven off our point. And so part of I tell this story for fun, but part of it was stick to your goal, and that's a really important aspect, and it's harder than you think. It's one of the main things when if you Google what are 5 things I need to learn about when I invest, one of them will be set your objective, but it doesn't tell you how to keep to your objective when times are crazy. And so that's part of, again, what I'm leaning into is that it's not as easy as it sounds to just set your objective, figure out what your risk tolerance is. There's a great investor actually back in the 1920s, and he always said, take stocks down to your sleeping level. This is Jesse Livermore, who was a great trader.
Jesse
Well,
Livermore?
yes.
Okay.
And he traded back in the early 1900s and wrote a great book with his stories. Actually, I tried to model mine after his. We'll see if people remember mine after 100 years. But um, but that sleeping level, sometimes we don't know what that is until we get to some weird time in the market. But sometimes you can figure out the best time to get it to your sleeping level is when times are good. And you say, okay, I've got this amount in stocks, but if it all of a sudden dropped 30%, would I be scared and wanting to sell, or would I be brave and wanting to buy? And you've got to ask that question. And the best time to ask it is in good times, not in bad times when you're scared.
Well, I mean, you hit the fundamental flaw of humans is we are not consistent. It's hard to be disciplined. I think it goes against the grain, but again, the rewards on the other side. So yeah, when your neighbor comes over and says, I bought Bitcoin and now it's worth 100 grand. Or when people watch the rise and fall in NVIDIA, that's probably the most recent. And so Bitcoin and NVIDIA, it's hard to sit idle. It's hard to sit on your hands and stick with your investment strategy when everyone around you seems to be getting rich quick. And of course, everybody wants to get rich quick, but we know the lesson in that.
It is. And it really is. It is, like I said, I think it takes some courage in your own abilities because, it used to be, you still, I mean, heck, before social media, people were buying Beanie Babies with, to try to save for colleges. So
No,
this
really not.
craziness, this craziness will never go away. But as you point out, human nature never changes.
No.
And we're just getting it flung in our face more often these days with social media. But there's the old story with the tulip bulbs back in, I think it was Denmark, back in the 1500s, and people were buying and selling tulip bulbs and trading them for houses. And I remember reading this story and thinking, that's crazy. Those people were nuts. It's human nature. And it's going on today. It goes on with the Beanie Babies, or for all we know, it's with crypto, and it's going to go on. Human nature is just unchanged.
Yeah, the collectibles market is just a whole nother market.
Yeah. Yes. Yes.
So this book has been out. Do you have another book in you, do you think? After you've gone through the process of one, do you think like, hey, I got another one in there?
I don't know yet. I found a lot of appeal with this whole mellow your money and taking your time and kind of taking the long approach as opposed to worrying about every day or every week with the market or with trading. And so I've thought sometimes maybe this mellow approach could work with other things, like mellow your politics or mellow your parenting. And I don't know yet. I've just thought, there's these all these series of books and maybe this whole mellow concept could be stretched into other areas of our lives.
You picked probably the two most divisive topics, but you're like, heck, I've already been in the financial
That's
market
right.
for a
I'm
while.
already trying to get people to calm down with their money. How about something else? I don't know if I'll get into that, but I
You're
love
like, I
what
have
you're
alligator
doing.
skin.
Exactly.
I think I meant from the point because you have so much knowledge in the market and what you've seen over time. And I know you've poured a lot of research and your stories into this book. Would there be another angle to come out with the financial?
I think I think there could be, and I think it could be for people who do want to be aggressive.
Mhm.
There are ways to try to do that I have tried and failed at
Oh,
over time. But it's kind of like this book. A lot of this book are some of my own misadventures in life and such. And so for those that wanted to be more active, there are some interesting rules that you could follow that I could not follow because of my own emotional makeup.
Mhm.
That might be an interesting story for people who want to be a mellow trader, let's say. This book is more for building wealth over the long term. It's for the average person who has some 401k money or maybe a recent inheritance, or is a young person getting started, in their 20s or something. I think this book could help people learn how to build over the long term. But there are ways to make money if you really want to focus on the short term that I did not cover in this book, and I kind of make light of my own errors and such. But maybe through those stories, I could kind of help people and kind of do something concurrently, like actually start an account and write a book about my experiences in trading, using these rules and see how they work or don't work. I thought that might be an interesting concept because some people, it's in their soul. I'm okay building wealth over the long term, but I had an uncle. And he said, "Boy, watching you invest is like watching paint dry." I couldn't stand it. He was aggressive, and he had his ups and his downs, but when he got hot, he could make some money. And
Mm.
so for that kind of investor, maybe there's another book for them.
Or you could come to market faster with a podcast where you have every episode be a different angle.
I kind of like the podcasting thing. I've kind of enjoyed it. I mean, it's fun talking with you and the different podcasts that I've been on. And actually, my son is going to begin working with me at the end of the year. And so
Okay.
I've thought, he and I have kind of a fun bantering back and forth, and that might be a good way to tag along with this too.
I mean, the Kelsey brothers seem to have a lot of fun, so it could be the Hyman men that are
There
having
you
the fun.
go. And I've sometimes thought, even before the Kelsey brothers, I can't remember who they were, Click and Clack or something, where they were like car repair people. And
Okay.
yet they were hilarious. This was back, many years ago, I guess. But you thought, why would I listen to a bunch of car guys? But they were really funny. And I think if you can make whatever it is fun, you do this with your podcast, and with whatever author's on, you make it very approachable. And I think that's what I would love to do with money too. So that's a great idea.
Well, because money itself is very intimidating. And so what people do is when they're intimidated, they either run towards it or they run away. And I think
Yeah.
it needs to be accessible at all levels. And I know that we tend to, the higher your income is, the more access you have to those resources. But if you could start something that's available to all socioeconomic levels via a podcast, that's really where I think you could grow.
Yeah, that's a great idea, and you're absolutely right. And that's what I've run into with clients over time. Some people are into it every other day, and some people they have ignored it. And I think both are errors that we make. Watching it every day can be really problematic because you get sucked into all this, news that's really worthless. It doesn't help you one way or the other. And yet, if you ignore it totally, I sometimes run into people who are very, are really emphasizing the spiritual path, that this is what
Mhm.
they really want to pursue and they want to, focus, and money they want to put to the side. But I don't care who you are, money is part of our lives. And if you ignore it totally, it will impact your spirituality too. How can you meditate if you're worried about paying the rent? And so it is something that you need to have at least a little bit of focus with. And really, once you set your objective and make your plan, sometimes you then can put it away.
Mhm.
One of my favorite clients was a lady that all she wanted to do was give money away. And so
Aw.
once we once we invested enough to set things up so she had a steady income,
Mhm.
and she had a lot of gains in her portfolios. It was very hard to sell anything because of the some of the stocks had been bought many, many years ago. And so we didn't do much for her other than give her the income each month so she could give it away. And we used to nickname her or the nickname the strategy benign neglect. Of course, we weren't neglecting her, but we were not doing much with her portfolio. And
Ah,
ironically, at the end of the year, we'd measure all the performance of everybody. Guess who outperformed? It was this Eloise, who we were doing nothing. We weren't trading. We were just letting things run.
with her high
Another,
dividend stocks.
exactly. And another story that kind of emphasized sometimes the less we do is the more that we're doing.
Well, if you could demystify and debunk, I think that would be really insightful for a lot of people.
That would be a great goal. And I think through the podcasting and through, people asking questions and such, I think that would be the probably the easiest way to do that. And keeping it light, keeping it fun. Because I think once you're too serious about this stuff, people, they've got other things they can do.
I agree.
And there's plenty to
So
laugh
talk.
at in this business. We're constantly making mistakes, and it's easy to poke fun and it doesn't have to be so serious as we see these solemn, I see these solemn people on TV, procrastinating about this or that, and I'm thinking, that you don't be so serious about this. We don't. It's none of us have the perfect crystal ball, so don't pretend that you do.
Okay, Mick, you got your work cut out for you. Let's transition into Russian literature. I found that kind of fascinating because one, it's very unique, and two, it's dense reading, right? Tolstoy is hard to get through.
It can be, but what I found, maybe it was the
Okay, you're
professor.
generous when you say it can be. It is.
Well, I think what confounds most people are the names. I mean, try pronouncing some of these people, and that's the problem. If you can get past the names, and I had a great professor in college that pronounced everything for us. Of course, the
Oh,
only one I remember right now is Raskolnikov. And
okay.
that was in Crime and Punishment, which I thought would be the most dense book I've ever read. And yet, amazingly, once you got into it, once you got past the names, it was a page turner because it was all about guilt, and it was intense guilt.
Mm-hmm.
And so it was that part of Russian literature that attracted me. It was the emotions. And so that's why I kind of identify it with the stock market, because it is the emotions that tend to overwhelm us. And not only in making us in how we invest, but sometimes in if sometimes you do have an intuition that it's a market bottom or a market top. And it's not from any statistics you'll read. It's not, unfortunately, by watching the Fed funds rate. It is oftentimes your gut instinct. And it comes from, I gave this analogy. I had an uncle, Uncle Lou, and every time he'd walk in the door, he'd grab your ear and he'd just torture you, and it was a say uncle,
Oh
and you were
gosh.
tortured until you said cry uncle. Now, the social services was never called on Uncle Lou or anything, but I remember in 1987, as the market was dropping, and it dropped 22% in one day. Imagine
Mm-hmm.
the excitement we get when the market's down 3 or 4% and people are, market plunges. This, it's terrible. Imagine 22% in one day.
Scary.
And right at the end of the day, one of the partners of the firm said, I got to sell something. And he went and he sold, I don't know, he sold some utility stock that wasn't even going down. And I thought, he's crying uncle.
Mm-hmm.
And and what I noticed was that was the bottom of the market. That was it. And that emotion of cry uncle, when we feel that pit of the stomach, oftentimes that's the bottom of the market. And so that's a long way from talking about Russian literature, but it is the emotions that I think that we need to deal with in the market. And so often we ignore that because it's so easy to fall prey to somebody, touting some number or some statistics or something about the economy, but that's not what's going to tell you about the market. It's oftentimes it's your belly.
Well, I think that has to be curated though, because with the market now, we keep thinking, is this the bottom? Is that the new bottom? Is that the new bottom? And so every day, I feel like the market nowadays is very reactive to every story, every jobs report, everything that comes out, the Fed comes out, their talks, it's so reactive. And I don't remember it being that reactive historically.
It um, it wasn't what we didn't have is the public hearing all these numbers
Mm-hmm.
because you used to have the 6 o'clock news, which I never watched, and you had the um, once a week there was something called Wall Street Week on half an hour. And so people just, it wasn't fresh in our mind, but the market always zigged and zagged like it is. If you look at the charts of today and zoom out a little bit and look at the charts from the 1980s or the 1990s, they actually look very similar. The market veered up and down and it reacted this or that. And sometimes it was an economic number or a Fed number, and sometimes it was something imagine when we invaded or when we attacked Iraq and all these different stories, and then the day after that, and then the day after that, and then all the news stories that are reacting to that, and even like when you look at today's market. There have been sharp moves, but if you zoom out and look at the picture and you say, how has it looked over the last 2 or 3 years? This right now just looks like a little correction. And I don't want to veer into politics or anything, but the market was up 20%, I believe, 2 years ago,
Mm-hmm.
28% last year. And so it's possible, we'll never know, that whoever won that election, the market was going to come off a bit because it had just had 2 amazing years. And so we know why the market is reacting the way it is right now with the tariffs and all the worries about that. And I won't comment on good or bad there, but that's a reason for the market to come down. Had the other person won back in November, the market might still be coming down for totally different other reasons because it was time for it to take a rest. In the video you talked about, what an amazing stock. And yet nothing ever goes up in a straight line. It was due to take a break. Now, maybe it's come off more than it normally would have because of the tariff worries. But I think that if we zoom out of the market a lot of times, a lot of these zig and zags don't, they look more normal. And so I think this market right now, who's to say whether this is a bottom or not? I tend to like things to settle out a bit before I would, call a bottom or something like that. I think it's probably too early in this move to say one thing or another. And a lot of times that's okay too. To say I don't know is a reasonable thing to say about the stock market. And if somebody said, what's it going to do from here? I think anybody that says they know is got to be making it up because, I mean, that it's very unpredictable. But what we probably know, what I believe I know, is that somewhere in the next 2 to 4 years, we're going to be okay. We're going to work through the situation. Interest rates are going to do a certain thing. The Fed will do a certain thing. The president will do a certain thing. And somehow we'll work through it because that's history. And that's history in so many different markets. And think of the Great Recession, the Great Depression, and in 1970s when people were worried about inflation recently. Imagine inflation at 12%. Mortgage rates were at 15% when I got out of college.
Crazy.
Somehow we survived these things.
So you had mentioned earlier that that's when people are in the market every single day, and so they're very emotional and reactive. It's similar to that. You're like, don't be looking at the individual, candlesticks up and down if you can pull back. And so if people are pulling back to look at what we did in the 80s and 90s, what tools would they find that on? Like if you don't have a brokerage account, where do you go to look for that information?
That that is there are there are ways to just Google if you Googled, Dow Jones Industrial Average or S&P 500 chart last 50 years, you would kind of see all the squiggles of the last, say, 50 years. And what's amazing when you look at that, I talked about that terrible crash in 1987, market drops 22%. If you look at that today, you look at that chart and you zoom into 1987, wow, that doesn't look like anything. Those
That is true.
people were scared to death of that. That
Of
was a
course.
nut. Well, it wasn't anything. It was something back then, but we survived it. And so that perspective, I think, is worth Googling for most people. The other thing is for most people who don't want to pay attention and just want to act like my client Eloise and kind of do just the benign neglect. With our 401ks, most of the time money is just taken out of your paycheck every month. And
Hmm. That's
I
the biggest
remember
one, neglect.
what a great way of saving because you're kind of neutral. If the market goes up, you're saying, oh, good, the market's up, I made a little money. If the market's down, you say, oh, good, the market's down, I'm investing at lower levels. And so I remember a colleague of mine saying, gosh, the best thing that could happen to us, this was back 25, 30 years ago. He said, best thing could happen is the market go down for 10 years, invest at lower prices, and then have it go up. And so if you invest every month like that with a set plan, whether it's a 401k or it's just your own savings, and
Hmm.
you just each month put it, whether it's $100 or 1,000 or $50, then you become more neutral and less excited about what the market is going to do. Because each month you're going to just put that predictable amount in. And in a down market, you're investing at lower prices. In the up market, you can cheer yourself on and say, oh, good. And that's another way of kind of taking the excitement out, but also the stress out of investing.
Well, how do people figure out what they are? How do they figure out if they're an Eloise or if they're like your uncle? Because I think also if you have never been an investor, you don't know what type you are.
I think what I would recommend is start with the LOEs. Start assuming that you're going to be a predictable long-term person, and then you can actually slowly, let's say that you started with $1,000, and over some period of years or whatever else, you've worked it up to $25,000, and someone talks to you about some risky thing that might make a lot of money over time. It's okay to take part of that money. Now you've worked yourself up, but don't take your 25,000 that you worked hard to get to. Take 1,000, take 500, take a little something, and then see how did you feel when that went up or down. And then you can slowly work up to being a little more aggressive. That's what I would recommend for most people. And then you can see how it feels. My uncle did the opposite. He was really aggressive with all his money. And when the tech debacle happened back in the late
Mhm.
1990s, he said to me, I know these stocks are going to work out, but I got to start selling because your aunt's going to divorce me because
Oh,
we're
geez.
losing too much money. I don't want to go back to work. And so he found out the hard way of how to balance himself. Now, the next time when the '08 crisis happened, he said, I've already got these conservative stocks on the side, so I'm not so worried. I'm going to still sell these bank stocks. But it calmed him down because he had already kind of had a conservative side and an aggressive side. And so each of us need to figure that out. Um, and if you have that, at some point you might say, I want to buy a little Bitcoin. I want to see what it's like. But don't make that the whole thing, or unless you're really willing to swing for the fences like that.
Yeah, pink sheets and international and those penny stocks, those are more risky, obviously.
No question. And I should say this, and I know other people would say this, that the first thing you really want to do before you even buy any stock would be some emergency fund that you're never going to have to worry about selling stocks if the car breaks down and you need to fix your car. That should be some fund that takes you through a lot of issues and problems. And after that, then I would say you can start, whether it's conservative investing or more aggressive, get that emergency fund first, because invariably, if you don't have that money available, that's when something happens.
Oh,
At least that's the way it
sure.
was in my life, you know.
Murphy's Law. Do you subscribe to the adage, pay yourself first?
I love that expression. And I had a client that always said that to his grandkids. In other words, of course, you've got to pay your rent and you've got to pay your utilities, but it's after that that you pay whatever it is you can figure out that you can put in whether it's the emergency fund at first or eventually investments. Do that at the front of the month. Don't wait at the end, because by the end of the month you've spent your money. And so put that money in, that investment money in early on, and then figure out what you've got to spend on everything else. I love that expression.
It's age-old favorite. I know we've talked a lot about personal, but you also have managed billion-dollar companies. So how are company investments different from personal investments?
So in some degree, especially institutions, when you think of a college endowment fund or a charitable endowment fund, that they're thinking in terms of almost infinity.
Yeah.
They're going to last forever. So what's their time horizon? It could be hundreds of years. And so their ability to live through a crisis is a lot easier than ours, because even if you're in your 30s, you're thinking, well, 30 years from now, I kind of want that money. And so and as you get closer to these time periods, it's important to know what your time period is. And so when we were investing for institutions and they said, we want you to manage our stocks
Mhm.
and we want to do the best you can, we didn't worry about whether the market was going up or down. We bought the best stocks we could at the moment, and trying to beat the market, that kind of thing. It was almost more of a competition of, could we do better than a passive index or what the market was doing? Because they worried about how much they should have in stocks. When they hired us for stock management, they said, we want you to do your best. And so the good part of that was you didn't have to worry about which way the market was. For me, it became a little monotonous because I liked the whole concept of managing someone's portfolio, of really making an impact on their life. And
What does
I
that
this
mean?
is
Expand on that a little bit differently. Because I know you said the universities tend to be like more growth driven, to be the
but
historical average. But when you manage someone's money, what does that mean?
So, in other words, if someone comes to me and whether they're a younger person that has a longer term time horizon or an older person that might be retiring, I need to figure out first, what is their risk tolerance?
Hmm.
What could they take up or down in the market? And what do they need? If it's someone approaching retirement, it's what income do they need out of the portfolio? And in a lot of cases, somebody might have plenty of money, and so they might be spending more than their income. But again, they don't have an infinite time horizon. Of course, they might want to pass a little bit on to their kids, but they could, you could spend your principal once you're in your 80s, because you're not going to live to 150,
Hmm.
And so figuring out what is it to balance, what they need to live on, and what we can invest in, and how the market, can affect them up or down. The goal really is to get people to where it doesn't matter which way the market's going, because we've got things in such a balance. I have one client who had some terrible experiences with other portfolio managers, got him sucked into financials in the '08 crisis, and he had too much technology in the late '90s. And so he was very skeptical, but over time, he's kind of gotten more comfortable that we have a balance that's not going to hurt him. And so he'll call me up sometimes and he'll say, Mick, I know what you're going to say. It's whatever is going to happen, but I need to hear it one more time. Am I going to be
Sure.
okay? And it's having that impact on someone's life that really made my work life more meaningful, I guess. And so that's what I really liked about it.
Well, I'd imagine so. They're insulated from the volatility to a point,
Yes.
but also you're helping them grow, invest, saving for a children's college or their a wedding or events. So it's kind of like you are taken along with them on their journey
And
through life.
exactly, and you become part of their lives. And I have a couple of clients I've worked for close to 30 years. And it's such a enjoyment to kind of see how things have moved for them. And now we've set up accounts for their grandkids and they've grown over time. And it's a really fun experience. And has given meaning to my career.
Oh, how rewarding and fulfilling, no doubt.
So, and you feel like, as you've said, that they become part of your life, and so anyway, that becomes to me a lot more fun than sitting in front of some committee for some corporation or something. The committees change over time. It's really not their money anyway,
Correct.
and so it was a little bit dry, but still taught me a lot, over time.
So I know we've talked about individual stocks, and I kind of subscribe to the old saying, you really have to like your underlying, because if you don't like the underlying, you're going to get a little bit scared of what that stock is doing. But I know a lot of people feel more comfortable with mutual funds.
I think what you've said, though, is so important, is knowing what you own.
Hmm.
And I passed a couple of stories along in my book, but just getting really to your direct point is that that's what's going to get you to kind of be, I think, have strong hands in weak markets is knowing what you own. If you know you own Microsoft and Apple and Procter and Gamble and Colgate and this diverse number of stocks, and yeah, any one of those over time could have their problems. And who knows 20 years ago whether we'll have Apple phones or not. BlackBerry, 25 years ago, we all had Blackberries. And
Oh
other
yeah,
than in our
good.
closet, I don't know who's using a BlackBerry anymore.
Yeah.
So it's not that we can ignore those individual stocks, but if you have a long list of them, it
Mhm.
does give you comfort in a weak market. And that's what I would say that people forget about when they buy mutual funds, is they have some fund called the Mick fund or whatever you want to call it, and if the Nick fund goes from $1,000 to $600, you're going like, oh, that's terrible. I'm selling that one. I'll buy another one. But you
Mhm.
don't know what it there's a website called Morningstar, and in
Morningstar.
Morningstar, and that's available for anybody. If you just Google Morningstar, you can look inside of any fund and see what their top 10 or 20 holdings are. And at
Mhm.
least you get a feeling for this is what I own. And so and I think mutual funds are great for people or ETFs, either way, because it's automatically a way to diversify yourself so you don't have to pay attention to the individual stock. But if you go that way, look it up. Understand how diversified am I? And when it does go down, which invariably markets go up and down, you will get comfortable because you'll look inside of that and say, oh, this is what I really own. It's these stocks. And that can give you a lot of comfort as opposed to just some name of a mutual fund or an index. You hear the S&P 500 index fund. That's fine. But what does it really own underneath it? That's what's going to help you.
I think that's an excellent point. The one thing too about mutual funds that I learned quite later in life that I wish I would have learned earlier is the cost basis can't be transferred to your beneficiaries upon your death. So, if so I heard a story, I had a client a long time ago who invested in Coca-Cola in 1950 and never sold it.
Wow.
I
Holy cow.
exactly. So his children inherited his stock. And so when you inherit stock, the cost basis moves to the price of the stock at the time of the death. And I thought thought that was absolutely fascinating because if you're a mutual fund, you don't have that, right? But their Coca-Cola stock, which I think in the 50s was like $5 or, it was just dollars.
Yeah, it was probably about that like that.
Dollars. So this was, in the 2020s, obviously that it had, almost 70 years. And so those children were obviously very wealthy on paper because the cost base just moved up to what Coca-Cola was selling at the time of the death. And I did not know that. And I think a lot of people don't know that when they are not, when they're going into mutual funds and they're older because maybe they want that, a balanced index or a value fund, or they want the,
right.
required minimum distribution for their living. But there's a
It's something, it is something to think about. And it's possible that may be a reason to choose an exchange traded fund or what they call an ETF, which does trade like a stock and may, I wonder, I'm not an accountant and I don't know the answer to this, but that's be worth someone asking the question to their accountant. An ETF might be a better way of going as opposed to a mutual fund because that would get the pass through on the capital gain. Potentially, it would get the write-off. That is a powerful thing. I've seen it work for and against people because imagine you owned some bank stock from the 1950s that did the same thing,
yeah.
and you said, I can't sell that stock because of the capital gain. But then in 2008, it goes from 50 to 4
Right.
back to where it was in 1950. You're going, oh, maybe I should have taken that capital gain. And so
Yeah.
it with Coca-Cola, it worked out beautifully. But I've seen there's an old expression, don't let the tax tail wag the dog or something like that, where pay attention to those tax benefits because it can be huge, but don't let it overwhelm you if there's something that needs to be sold.
True. You have a question in the comments.
Yes.
Mick, any advice for a college student wanting to learn more about finances/money? Good question.
So there's a great book called Mellow Your Money. I'm kidding. That's
Miss,
I think I do think that listening to these kind of podcasts and getting a feel for um, kind of the basics of it and not getting too sucked in um, to these if you take a course on finances or something, it might just bore you to death. Some
it will.
people might like it, but I would say that it's the podcast thing. If you listen to a few podcasts and also get your feet wet a little bit. I wasn't kidding about the emergency fund, but the way to learn about investing is buy a little bit. You can buy some of these ETF funds for $5 or $10. I mean, you don't have to invest a lot, but getting your feet wet a little bit is a great way of learning and watching. And believe me, once you own something and you see it going up or down, you feel it, and then you want to learn a little bit more. And so I would advise that. The other thing is, if you want to have some fun, I talked about Jesse Livermore, who wrote the book. It was called Reminiscences of a Stock Operator, and it was written about 100 years ago. And that book taught me so much about the market and about investing, and I have not found a better book since. And so, if you really kind of want a softer way of getting into the stock market a little bit, that's another one I'd recommend.
All good advice. Thank you. So we are, that was a fast hour. Two more things. If you could wave a wand, where would you be in it 1 year?
Where would I be in 1 year?
Yep. If we want to manifest it out to the world, where do you want to be in a year?
Wow. I'm very fortunate. And if I waved a wand, I would love to be in my nice home in San Diego, as happy as I am today, working with my son. And I'm sure, you could create a wonderful resort in um, I don't know where, Tahiti or something, but I love where I live. And so I'm as happy as can be. And I would hope that I would be growing through the year. I would be learning more. I'd be on more podcasts like yourself. Maybe I'd be doing a podcast in my home. That might be the only change I'd
There
have
we
right now.
go. Mick, where can people find you online? Where do you hang out? Which social platform? And where can they buy your book?
I hang out on Instagram though, and I'm even getting better technology wise now that I've gotten on your show. But my website is mellowyourmoney.com. I'm on LinkedIn, and also through my website you can contact me. I'd love to talk to whoever wrote the question more. I'm willing to email and text and whatever else. I'd be happy to do that. And the book is on Amazon.com. And if I had one last thing to pass on as we're talking, it's I've learned the most through my experiences and through the people that have been in my life. And sometimes it's the uncomfortable people that are, around you that can be great teachers. Sometimes it's experiences that you wouldn't necessarily have wandered into voluntarily. But if we can learn from all our experiences and take that with us, it's just a great gift. And so I would pass that along.
Oh, excellent advice and the best way to close out our interview. So thank you so much for being on my show. And it has been lovely getting to know you.
Thank you, Gigi. I've really enjoyed it. Really appreciate the opportunity.
Thank you, Mick. Have a nice evening.
You too. Bye bye.